Today, we're plunging into a story that, well, it begins with a pretty universal frustration, I think, and ends up as this global revolution in how we move and, frankly, how we live.
It really does.
Picture this, if you will. It's a snowy, biting night in Paris, way back in 2008. The air is crisp, streets are slick, and two guys, Garrett Camp and Travis Kalanick, have just left a conference.
Right.
And they're standing there, just stuck. Totally stuck.
Yeah.
Chilling weather, trying their best, but not a single taxi in sight.
We've all been there, haven't we? That feeling.
Exactly. That simple, really relatable annoyance of being stranded, needing to get somewhere, but just being at the mercy of this, unreliable system. That specific moment of friction, that desperate need for a ride, that was the spark. It would eventually rewrite the whole fabric of urban transportation, pretty much worldwide.
It's a profound illustration, really, how a personal inconvenience, something experienced by these two entrepreneurs, can just ignite this monumental shift.
Yeah.
And what came out of it wasn't just another company, it was an entirely new industry. Uber was, born directly from that struggle, that simple need to get a ride. And in doing that, it fundamentally transformed an industry that hadn't really changed in decades, right? Still clinging to analog systems in a world that was rapidly going digital.
What an impact from such a, simple problem, relatively speaking. So today, we're unwrapping the incredible, often pretty turbulent, but ultimately transformative story of Uber.
It's definitely got its twists and turns.
Oh, yeah. We'll trace its journey from those humble, maybe frustrated is the better word, beginnings, all the way to its current status as this nearly, $190 billion global powerhouse, shaping everything from your morning commute to, what you had for dinner last night.
It is everywhere.
So our mission in this deep dive is to distill the most important nuggets of knowledge from the sources you shared with us, articles, research, financial reports. We want to blend some entertaining storytelling with, deep financial and strategic insights. We'll explore the dynamic personalities behind the brand, those pivotal moments that really defined its path, the financial muscle it flexes today, and what its ambitious future might look like for you and for the world.
It's truly a fascinating journey. Disruption, resilience, strategic evolution. There are lessons here far beyond just the ride-hailing industry itself.
Definitely.
Let's begin right at the beginning then, that genesis, that cold night in Paris.
Yeah, let's do it. So that frustrating night in Paris, it really planted a seed, especially for Garrett Camp. Now, he was a Canadian entrepreneur, already co-founder of StumbleFun. Remember that?
Yeah, the web discovery platform.
Yes.
Exactly.
So he had this deep understanding of digital products, user experience. But it wasn't just Paris. He also had this ridiculously expensive private driver experience on New Year's Eve.
Ah, okay. So it was piling up.
It really solidified his conviction. He started thinking, what if there was an app, something that could summon a luxury car with just a tap, making on-demand transport not just convenient, but actually more affordable, more accessible.
Interesting. So his initial vision was quite high-end.
That was his initial vision, yeah. A high-end, reliable black car service, but sort of democratized through technology.
And that's where Travis Kalanick enters the frame, right? Bringing a very different kind of entrepreneurial energy.
Totally different vibe.
Kalanick was, a serial entrepreneur, background in peer-to-peer file sharing. Remember Scour, Red Swoosh, famously contentious companies.
Oh, I remember the headlines.
Right. He joined Camp not just as a co-founder, but as what they called a mega advisor, like a force of nature. And while Camp was initially thinking, okay, let's own and operate a fleet of luxury cars, which is a really capital-intensive model.
Hugely expensive.
Kalanick, with his, let's say, aggressive growth tactics and that visionary drive, he pushed for something much bigger, something far more scalable.
Which was?
A platform-based, asset-light ride-hailing app. The key was, Uber wouldn't own a single vehicle.
Ah, the platform play. That was the critical distinction, wasn't it?
Absolutely critical. It transformed the business model entirely. They went from potentially being a fancy taxi company to being a technology platform, just facilitating connections.
A digital orchestrator, not a car owner.
Precisely. And that decision really set their early direction. Turned out to be, a stroke of genius in terms of scaling.
So with this combined vision, Uber Cab, that was the original name, was officially founded March 2009, San Francisco.
Right.
They brought in a small, pretty agile team to build that initial prototype. Ryan Graves was actually the very first employee. Joined in February 2010. Apparently, he responded to a tweet from Kalanick.
Is that right? Wow. Talk about modern recruiting.
Seriously. He even briefly served as CEO, kind of getting things off the ground, before Kalanick, with his relentless drive and conviction, took over as CEO in December 2010.
And there were others involved early on too, right? Helping build it.
Yeah, Oscar Salazar and Conrad Whelan, they played crucial roles in developing that first prototype, literally getting the digital wheels turning, so to speak.
And those early operations, they were quite specific, weren't they? Focusing on that premium market.
Exactly. Launched in San Francisco in 2010, expanded through 2011, but it was exclusively a luxury black car service.
Right. So imagine, sleek, professional car arrives when you need it, summoned by your phone, very high-end, reliable, premium experience. Targeting those early adopters, people willing to pay for convenience.
It was still Uber Cab then, but the founders, they quickly saw the bigger potential, right? This idea of an on-demand transportation network.
Yeah, much broader than just black cars.
So by 2011, recognizing that bigger ambition, they officially renamed the company just Uber, signaling, they were moving beyond just cabs towards this broader vision of mobility and eventually much more.
And that's when things really started to accelerate, I imagine.
Oh, yeah. This is where it gets really interesting. The story takes a huge turn. In 2012, Uber introduced the true game changer, UberX.
UberX. That was the moment, wasn't it?
That was the moment. They moved beyond just the fancy black cars.
Right.
Fundamentally changed the industry. They opened the platform up to everyday drivers, using their personal vehicles after background checks, of course.
Right. Important caveat.
But suddenly, personal transportation wasn't just for the elite anymore. It was accessible to pretty much everyone.
This shift, the launch of UberX, it was almost like democratizing personal transport on a massive scale.
Yeah, that's a good way to put it.
Think about mobile phones, right? Before them, landlines were common, but mobiles put communication in everyone's pocket, made it ubiquitous.
Good analogy.
UberX did something really similar for rides. It didn't just offer an alternative, it made on-demand personal transport accessible to the masses. Hugely broadened the market, Uber's reach, in a way that was, frankly, unimaginable before.
And it unlocked this massive new supply of drivers too, right? People using their own cars to make money.
Exactly. Created this truly disruptive marketplace dynamic. Supply meets demand in a whole new way.
That's a perfect analogy, the mobile phone one. Truly transformative. And this democratization, it fueled just massive, almost dizzying growth. UberX was the engine, wasn't it?
Absolutely the engine for rapid global expansion. Ignited what you could only really call an international blitz.
The numbers are kind of staggering. By 2013, just 1 year after UberX launched, Uber was already in 65 cities worldwide.
Incredible pace.
And it didn't slow down. It accelerated. By 2016, 500 cities across the globe. And today, as we're talking, Uber operates in over 70 countries, spans more than 15,000 cities.
It's just unprecedented market penetration, really, the speed of it.
Astonishing. And alongside this rapid expansion in rides, they also started diversifying early on, didn't they? Recognizing the power of the platform itself.
Yeah, that was crucial. They saw it wasn't just about moving people. In 2014, they launched Uber Eats.
Eats. Huge now.
Huge now, yeah. But back then, it was a significant strategic move. Moving beyond passengers to moving things specifically, food from restaurants to consumers. It laid the groundwork for their future as this multifaceted logistics platform, proved they could leverage that driver network for different kinds of demand.
And they started Uber Freight around then too.
Around the same time, yeah. Aiming to digitize and optimize the trucking logistics industry, which is, fragmented, often inefficient, another vast market ripe for disruption.
So these early steps were critical, showing the versatility of the tech and the network.
Absolutely. Demonstrating scalability beyond just rides.
But this era, this period of hypergrowth, it wasn't all smooth sailing, was it? It was famously known as the growth at all costs era, largely defined by Travis Kalanick's approach.
Right. His aggressive, often described as principled confrontation style of entering new markets.
Which meant basically clashing head-on with established industries, regulators, pretty much everywhere they went.
And clashing is maybe an understatement. This period was marked by intense, very public conflicts. Traditional taxi industries fought back hard. Protests, lawsuits, political lobbying.
Yeah, trying to protect their turf.
And at the same time, global regulators were often caught completely off guard. Uber's model was new, often deemed illegal or just totally unregulated in many places, which led to countless legal challenges, fines, even temporary bans in some cities.
I remember the battles in London, New York, Paris. Fierce resistance from these powerful, entrenched interests.
It was a time of immense legal uncertainty, cultural battles. Uber was pushing boundaries, often operating in this sort of regulatory gray area.
And that aggressive stance, while it fueled amazing growth in market share, it also created huge PR problems, right? Built up a lot of pressure internally and externally.
Significant corporate and public relations challenges. Yes, a considerable amount of pressure was building.
Definitely did. But even amidst all that disruption and aggression, Uber also showed some early signs of strategic adaptation. Almost pragmatism, surprisingly.
That's true. In 2016, they made that pivotal decision to sell their China operations to Didi Global.
Right. Took an 18% stake instead.
Exactly. And then in 2018, they merged their Southeast Asia business, which was intensely competitive with Grab, for a 27.5% stake. These weren't just retreats, they were really strategic calculations.
How so? What was the thinking there?
Well, take China. The regulatory hurdles were immense, local consumer habits were deeply ingrained, and the competition from Didi was just brutal. It was a cash-burning battleground.
An unwinnable war, maybe.
Arguably, yes. Uber realized that continuing to just bleed capital there was strategically unsound. So by divesting and taking a significant stake, they turned this capital-intensive operational headache into a passive but still valuable investment in the market leader. Smart move.
And Southeast Asia with Grab. Similar logic.
Pretty similar. They recognized Grab's localized strength and nuances of that market, so they opted for a strategic alliance. They got exposure to the region's huge growth potential without the ongoing burden of direct head-to-head competition.
So it shows this pragmatic approach, right? Knowing when to fight and when to maybe team up or step back strategically for the long term, even if it means giving up operational control.
Precisely. It's a masterclass in market adaptation, really, understanding the local context.
So the journey to becoming this global force was incredibly tumultuous, noisy. As we get closer to 2017, the storm really started gathering, didn't it? And specifically around Travis Kalanick.
Yeah, things really came to a head. There was this cascade of escalating scandals, mounting legal challenges, and those really unsettling allegations of a toxic workplace culture, the whole bro culture thing.
Right.
It was just a series of internal and external pressures that finally culminated in Kalanick's resignation as CEO in June 2017.
A huge moment.
Undeniably a watershed moment in Uber's history. It marked the definitive end of that founding era, that hyper-growth, disrupt-at-any-cost phase.
A necessary reckoning, maybe.
I think so. A painful one, but necessary. The company had grown at this unprecedented rate, but that growth came with significant cultural and operational baggage. It just had to be addressed for long-term viability, for public trust. The company had become almost synonymous with controversy by that point.
Exactly. So the big question then became, what does this massive leadership void mean? Here's a company still burning through cash like crazy, facing global regulatory backlash, and now suddenly without its aggressive, visionary, but also very controversial founder at the helm.
Yeah, Uber was kind of adrift. It needed a captain who could not only steady the ship, but chart an entirely new, more disciplined course.
And the answer, as it turned out, would come from a pretty unexpected place.
Indeed it did.
That unexpected place was Expedia, from where Dara Khosrowshahi, who had been their long-serving CEO, stepped in to take the reins at Uber in August 2017.
Right.
And his arrival, well, it truly ushered in a completely new era for Uber, a really distinct shift in philosophy and strategy, everything.
Khosrowshahi's immediate focus was clear and multifaceted. He had to tackle the biggest issues head-on. First, he committed to fundamentally shifting the company culture, moving away from that aggressive growth-at-all-costs mindset towards something more disciplined, inclusive, ethical.
How did he do that?
Well, emphasizing transparency, accountability, building a more professional leadership team around him. Second, and this was critical, he prioritized repairing those really strained relationships with regulators globally.
Huge task.
Huge. He adopted a much more collaborative tone, trying to work with cities and governments, not just fight them. And third, he placed a really strong emphasis on profitability and operational efficiency, a major pivot from the previous era's focus almost solely on market share. This was about proving Uber could actually be a sustainable business, not just a disruptor burning cash.
And this whole cultural and strategic shift, it was kind of encapsulated in this new long-term vision he laid out, wasn't it? The operating system for everyday life.
Exactly. That became the new North Star for the company. This idea of a single app designed to help you go anywhere and get anything.
It's a massively ambitious concept, isn't it? Suggests being like everywhere in daily life, way beyond just catching a ride.
It is indeed. And it transforms Uber from just a ride-hailing company into this comprehensive, almost indispensable platform for urban mobility and logistics. And this vision, it breaks down into several key interconnected pillars, each designed to leverage Uber's core strengths.
Okay, so what are the pillars?
Well, first and still fundamental is mobility. So remaining the dominant global platform for personal transport cars, bikes, scooters, you name it.
What about things like air taxis? They were exploring that, right?
They were, with Uber Elevate partnerships, but Elevate was ultimately divested to Joby Aviation in 2020. It was a strategic choice, really, positioning Uber more as a partner and a demand aggregator for these cutting-edge technologies, rather than trying to build the hardware themselves and taking on that massive capital risk.
Okay, so providing the marketplace, not the vehicle itself, makes sense.
Exactly. The second pillar is delivery, which, as we know, truly surged during the pandemic.
Became absolutely essential.
Right. Not just Uber Eats for food, but rapidly expanding into groceries. They acquired Corner Shop in 2022, even alcohol, with the Drizzly acquisition in 2021. And they've expanded into other goods delivery with Uber Direct, essentially aiming to deliver anything you might need, retail items, prescriptions, right to your doorstep.
That diversification really proved vital during the pandemic, didn't it?
Absolutely vital. Kept them afloat and growing when mobility just stalled. The third pillar is freight, aiming to digitize and optimize the complex, traditionally inefficient trucking logistics industry, another massive market, using their tech platform to connect shippers with carriers, streamline moving goods long distances.
Okay, mobility, delivery, freight, what else?
Then there's advertising. This is a rapidly growing, really high-margin business, leveraging Uber's massive user base and all that transactional data for highly targeted ads across their apps.
Like sponsored listings and eats. Or ads in the car.
Exactly. Sponsored listings, in-car tablets, you name it. This segment is growing fast annual run rate over $1.5 billion by Q1 2025. It's a remarkably smart way to monetize all that user data and engagement beyond just taking a cut of the ride or delivery. Creates a new, highly profitable revenue stream.
Very clever. And crucially, we have to talk about future tech and autonomous vehicles, AVs. That ties right into the operating system idea.
Absolutely. And this is fascinating because remember, Uber isn't developing its own self-driving cars anymore. They strategically sold their self-driving unit to Aurora Innovation back in 2021.
Right. So what's the strategy now?
Instead, they're positioning themselves as a key partner for AV developers. They provide the vast network of demand, the logistics expertise that these AV companies desperately need to scale up. We're seeing partnerships now with Motional, Waymo in Phoenix, NeuroDriver, which is planning like 20,000 Lucid vehicles for a premium Robotaxi service, even Baidu Apollo Go outside the US and China.
So the partnership strategy is key. Why is that so profound?
It's truly critical because it aims to drastically alter Uber's unit economics. That's the revenue and cost for each ride or delivery. If you can eliminate the driver cost in the long term through automation, well, that significantly expands margins.
Huge potential cost saving.
Exactly. And the genius here is how Uber redefined its competitive moat. Instead of sinking billions into R&D to build the cars, they're leveraging their platform's immense scale to partner with the innovators. They essentially externalize the massive capital risk and development burden to the AV companies, while Uber keeps control of the crucial demand side of the equation and takes a cut of every autonomous ride.
That's a masterclass in platform leverage, turning potential competitors into suppliers. Very smart.
Very smart indeed. Then, on a more environmental note, there's sustainability as a core pillar, aligning with global consumer and regulatory expectations.
What are their goals there?
Ambitious ones. To be a zero-emission platform globally by 2040, with 100% of rides in EVs, public transit, or micromobility in key markets, US, Canada, Europe by 2030.
Wow, 2030 is not far off.
No. So they're actively supporting drivers transitioning to EVs, incentives, partnerships, education, and working with NGOs. It's a significant long-term commitment.
Okay. And the last pillar.
Lastly, the Uber One subscription. This is profoundly significant. It's their membership program, maybe $9.99 a month, roughly, offers benefits like discounts on rides, deliveries, 0 delivery fees on eligible orders.
Why is that so important strategically?
What's truly fascinating and a key insight into their monetization is that Uber One members drive over a third of total bookings, and they are reportedly 3 times more profitable than single-service users.
3 times, wow.
Yeah, so it's not just about discounts, it's a sticky product. It encourages using multiple services, boosts loyalty and frequency across the whole platform, and creates this highly predictable, high-margin recurring revenue stream. It essentially locks in their most valuable customers.
That's a truly comprehensive blueprint for integrated growth, isn't it? Mobility, delivery, freight, ads, AV partnerships, sustainability, subscriptions, all interconnected.
Exactly, the operating system taking shape.
Okay, so that's the strategy under Khosrow Shahi. Now let's talk about the major financial and operational milestones that really define this era. The proof points that this new strategy was actually working, bringing Uber to where it is today.
Right, the journey to its current standing. One of the most anticipated moments, which then turned out quite tumultuous, was the IPO, the initial public offering.
May 2019, right? $45 a share on the NYSE.
That's the one. Heavily hyped, expected to be one of the biggest tech IPOs ever. But it had a, well, rocky start.
Understatement of the year, maybe. I remember it being called the worst first-day dollar loss in U.S. IPO history.
Yeah, it got characterized that way by some. Partly high valuation expectations, market skepticism about long-term profitability for gig economy companies, maybe a general cooling towards tech IPOs around then. It definitely wasn't the triumphant debut they hoped for.
No, not the splash they wanted. But then came 2020 and the pandemic. An existential crisis for so many businesses.
A severe, immediate hit to the mobility segment, yeah. Lockdowns just stopped people moving. Ridership plummeted overnight.
But this is where that diversification really showed its worth, right?
Yeah.
The pivot.
Absolutely. A crucial, massive shift to delivery. Uber Eats surged dramatically. Millions staying home, relying on food delivery. It demonstrated the true resilience of that diversified model. The delivery arm basically kept the company afloat, even growing when rides were stalled. Proved the wisdom of building that operating system.
That pivot wasn't just crucial, it was like a lifeline, wasn't it? And it set them firmly on the path to profitability, which was Khosrow Shahi's big goal from day one.
Exactly. And they hit milestones there. First quarterly adjusted EBITDA profitability in Q3 2021. A significant moment, proving the business model's viability, showing they could generate cash from operations even mid-crisis.
And they kept building on that, right? It wasn't just a one-off.
No, they scaled it. Reached adjusted EBITDA profitability for the full year 2023. Consistent discipline. And then the really landmark achievement, their first full year GAAP operating profit.
GAAP profit, the standard accounting measure. Yeah. That's the big one.
That's the big one. Hit a robust $1.1 billion in 2023, and they've sustained that, built on it, in Q4 23 and Q1 24. This wasn't a fluke. It felt like a structural shift, driven by scale, efficiency, those diversified high-margin revenue streams like ads and subscriptions starting to kick in.
That sustained GAAP profitability, that must have really validated the turnaround in the market's eyes.
Absolutely. And a huge validation came on December 18th, 2023. Uber was included in the prestigious S&P 500 index.
Right, joining the big leagues.
Exactly. A clear signal of maturity, recognition from the financial community, status as a blue-chip stock, attracts more institutional investment too.
And if that wasn't enough to signal confidence, what about the share buyback?
Yes. February 2024, they announced a massive $20 billion share buyback program set to start August 2025.
$20 billion, that's a very strong signal for management, isn't it?
Huge signal, shows profound belief in future growth, sustained profitability. A buyback of that scale directly supports earnings per share, fewer shares outstanding. And it reflects robust cash generation. They have excess capital to return to shareholders.
It really underscores that transition, doesn't it? From cash-burning startup to mature, value-generating enterprise.
Indeed. It signifies Uber has truly turned a corner, focused on delivering substantial shareholder value through disciplined financial management and strong cash flow, a powerful statement of financial health and future outlook.
Okay, so after all that strategy, those milestones, the journey to profit, what does Uber's financial engine look like right now? Let's dive into the nuts and bolts, give you a clear picture of its market standing today.
Sounds good.
As of, let's say, August 11, 12, 2025, Uber's stock, ticker UBER, is trading around $90.58 USD, give or take.
Right.
Which gives it this formidable market capitalization of around $188.9 billion, maybe $189 billion. Huge number. Puts it among the largest companies globally.
And if you look at its 52-week range, the stock's traded robustly between about $59.33 and $97.72. And significantly, it hit its all-time high just last month, July 2025.
Wow. So strong upward trajectory, surging investor confidence recently, especially after nailing that consistent profitability.
Exactly. And the recent growth has been quite significant. Year to date, as of early August 25, up over 52.8%, over 34% in just 1 year, and over 170% in 5 years.
Those aren't just gains. That's a strong indicator of market beliefs in the long-term strategy, isn't it?
Absolutely. Though it's worth noting it's beta.
The volatility measure. What is it?
It's 1.43, which indicates it tends to be more volatile than the broader market. So yeah, higher potential returns, but also higher potential for price swings. Something for investors to keep in mind.
Good point. So let's look at the latest numbers. Q2 2025 results ended June 30th. What did they report?
Revenue came in at $12.7 billion. That's up 18% year over year. And importantly, it surpassed analyst estimates. Shows strong execution, continued demand.
And earnings per share, EPS.
$1.63, also beating forecasts, which is a key metric investors watch for profitability per share. And adjusted EBITDA, that measure of operational efficiency, was $2.1 billion, up a remarkable 35% year over year.
35%. That indicates really strong operating efficiency, margin expansion. They're getting more profitable as they scale.
Precisely. And they also reported exceptional cash generation, operating cash flow of $2.6 billion, free cash flow of $2.5 billion, highlights their ability to convert those earnings into hard cash, sign of a truly healthy business.
Powerful numbers. What about the different parts of the business? Mobility versus delivery?
Mobility gross bookings were up 18% year over year. Continued strength, resilience in the core rides business as people get back to moving around. Delivery revenue was up a respectable 12%.
Still growing, but slower than during the pandemic peak.
Exactly. Slower growth post-pandemic compared to that explosive phase during lockdowns, but still a very substantial foundational contributor to the overall revenue picture.
Okay, so the company looks financially strong. What are the experts on Wall Street saying? The analysts.
Overwhelmingly positive. The consensus is basically a strong buy or buy. About 79% buy ratings from, I think, 57 analysts surveyed, only a handful of holds, and 0 sell ratings.
0 sells. That's a powerful vote of confidence from the financial community.
It really is.
And their price targets. Where do they see the stock going in, say, the next 12 months?
The average 12-month target comes in around $102.82 to maybe $108.27, which represents a potential upside of roughly 13% to 20% from the current price. So analysts generally see more room for growth in the near term.
Okay, an average upside.
Yeah.
Well, there's usually a range, right? What are the high and low targets?
Yeah, the range is interesting and tells a story. You see some cautious lows, maybe around $82, $84 from firms like Citigroup, Canaccord Genuity, perhaps factoring in regulatory risks or competition. But then you see some very bullish highs. Evercore ISI at $150, BMO at $113, Morgan Stanley $115, JP Morgan $110, a pretty wide spread. Indicates different views on the risks and the opportunities ahead.
Definitely different views. So what's driving the dominant bullish sentiment?
Several key factors. First, Uber's undeniable market leadership and those powerful network effects creates a strong competitive moat. Second, consistent JAP profitability and that strong free cash flow potential, proving the model works. Third, the significant leverage to future tech like AVs, huge potential margin improvement there. And finally, that massive $20 billion buyback, signaling confidence and boosting shareholder returns.
Any quotes that capture that sentiment?
Yeah, you hear things like, Uber's platform advantages and scale are becoming increasingly evident in its financial results. That might be JP Morgan or similar. Or this shift to profitability is structural, not cyclical. Maybe Goldman Sachs said something like that, meaning it's built into the operations, not just a temporary market blip.
Yeah.
These insights really underscore the confidence in the long-term trajectory.
Powerful validation. But even with all that optimism, there are still cautious concerns, right? Risks on the horizon.
Absolutely. Every investment has risks. The main concerns include those ongoing regulatory hurdles globally, especially gig worker classification.
If drivers get reclassified as employees.
Yeah, in major markets, that could significantly impact their cost structure, their profitability. It's a big question mark. There's also intense competition, particularly in delivery, where margins are often tighter, local players fight hard.
And driver supply.
Driver supply and costs, yeah. That's a persistent challenge. Ensuring enough drivers, managing compensation fairly. It's a delicate balancing act. Plus, the business is still sensitive to the broader economy. If there's a downturn, discretionary spending on rides and delivery could take a hit.
And the AVs, while huge upside, also carry risk.
Definitely. The timeline, the immense cost, the uncertainty around regulation and public acceptance, that's a major risk factor. It's a long game.
Okay, that gives us a really solid, nuanced picture of where Uber stands today. Mature, financially robust, but still facing challenges. But for anyone looking long-term, the real question is always, what's next? How might this giant evolve?
Right, peering into the crystal ball.
Let's turn our gaze to the horizon. Explore Uber's long-term trajectory, say 5, even 10 years out.
And it's crucial to emphasize here, as we look ahead, these long-term targets are inherently speculative. They rely on big assumptions about tech, markets, regulation. It's a rapidly moving target in a super dynamic industry. So these are scenarios, not guarantees.
Absolutely. Speculative scenarios. So let's start with the 5-year outlook, taking us to around 2029, 2030. What kind of range are we seeing there?
Estimates vary quite a bit, reflecting that uncertainty. But projections often fall somewhere between $110 and $180. Some forecasters, like CoinCodex, estimate a max of $180. Long forecast projects an average around $165 by late 2029. Substantial increases from today.
Okay, so what would a base case look like to get into that $120, $140 range?
In a base case, you'd assume continued leadership in core mobility, steady delivery growth and sustained profitability, and successful sort of measured expansion of advertising and freight. This implies a pretty impressive EPS compound annual growth rate, maybe 41% through 2027, then sustained competitive edge, efficient operations. Basically, solid, consistent execution on the current strategy.
Okay, solid execution. But then there's the much more ambitious bull case, right? Targeting $200 plus maybe even $300 plus by 2030.
Right. That requires some serious acceleration, some groundbreaking shifts. We're talking significant acceleration in mobility penetration, especially internationally. Delivery achieving much higher margins than it does now. Advertising becoming a truly major high-margin revenue engine.
And the key ingredient, AVs.
Crucially, yes. Meaningful progress and widespread commercial deployment of autonomous vehicles through their partnerships. That's what would significantly reduce the biggest operating cost, the driver. ARK Invest, for example, famously projected Uber could hit $200 plus by 2030 if AV successfully cut ride costs by like 60%. Makes rides drastically cheaper, more accessible.
Okay, that's the 5-year. Stretching even further out, 10-year outlook, 2034, 2035. Projections get even more speculative here, right? Venturing into truly transformative territory.
Absolutely. Wildly speculative territory, maybe. Some forecasters are eyeing 180, 250 plus analysis. Others, more boldly, suggest Uber could become a $1 trillion stock.
$1 trillion. Wow. That implies prices reaching $500 or even higher.
Potentially, yeah. Coin price forecast specifically targets $300 for context, but the $1 trillion talk is out there.
What has to happen for that kind of, frankly, astronomical growth? What's the engine for $500 plus M?
It hinges almost entirely on the successful, widespread integration of autonomous vehicles into Uber's platform. If AVs can fundamentally change the unit economics...
Cheaper robotaxis, no driver costs, operating 24/7.
Exactly. That could lead to significantly higher margins, massive market expansion by making rides dramatically more affordable, more ubiquitous. In that scenario, Uber truly becomes that dominant global operating system for everyday life, spanning mobility, delivery, logistics, freight, maybe even new fintech services, an indispensable utility.
So for that really bullish long-term growth, the $1 trillion dream, what are the absolute key assumptions? What has to go right?
Okay, key assumptions. 1, AV tech matures safely, cost-effectively, and on a timeline allowing widespread commercial use, not just pilots. 2, Uber maintains platform dominance against new tech and competitors, keeps attracting riders in autonomous fleets. 3, successfully monetizes its data and advertising to the absolute fullest potential. 4, successfully navigates that complex, fragmented web of global regulations, avoiding major setbacks. And 5, effectively expands into new verticals deeper into grocery, healthcare logistics, maybe eventually urban air mobility without messing up its core strengths or overextending itself.
A lot has to go right.
Yeah.
But there are also significant risks, right? The bear case.
Yeah.
What could derail these lofty ambitions?
Absolutely. If AV timelines slip dramatically, tech hurdles, safety issues, regulatory delays, or if competitors Tesla, Waymo, automakers capture significant AV market share and Uber can't secure enough good partnerships, that severely impacts the long-term unit economics.
Regulatory fragmentation could also hurt.
Big time. Different regions with different restrictive rules for gig workers or AVs could seriously hinder growth, increase costs, unforeseen tech disruptions, a major economic downturn hitting spending, or if Uber just fails to innovate and adapt, Those are major risks too.
Any analysts putting numbers on a bear case?
Moffett-Nathanson, for instance, suggested a bear case target of maybe $60, $70 if the delivery segment stagnates or their cost structure fundamentally changes for the worse. Highlights how critical continuous diversification and execution beyond just rides really are.
That's quite the spectrum of possibilities, isn't it? Shows how dynamic this whole tech world is, even for a giant like Uber, highly susceptible to external factors.
Absolutely. Nothing is guaranteed.
All right, let's pivot now and turn our attention to the intense arena where Uber actually operates day to day. The competitive landscape, because Uber doesn't exist in a vacuum, right? It's constantly battling formidable rivals on multiple fronts, relentless fight for market share, user loyalty.
That's right. Uber operates in the gig economy, a highly competitive global space. And the primary competitors vary depending on the segment and geography.
So who are the main players they're up against?
In rideshare, you've got Lyft, mainly US and Canada, Didi Global, the absolute dominant player in China, Bolt, big focus in Europe and Africa, often known for aggressive pricing, and Grab, the super app dominating Southeast Asia.
Okay, that's rides. What about food delivery?
Food delivery, the main rivals are DoorDash, clear market leader in the US. Then you have Grubhub, Just Eat, takeaway strong players in various international markets.
So what fundamentally binds these companies together? What are the similarities in this gig economy battle?
Fundamentally, they're all gig economy platforms. They connect independent contractors, drivers, couriers, whatever, with consumers via sophisticated mobile apps.
Using complex algorithms, real-time data.
Exactly, to match supply and demand, optimize routes, manage pricing, and critically, they all face similar regulatory and labor classification challenges everywhere. How are contractors defined, compensated? What safety nets exist? It's a persistent, evolving challenge for the whole sector.
But then what truly differentiates Uber? Where does it get its competitive edge in this really fierce battle? It must have some unique advantages.
Uber's greatest strength, its kind of competitive superpower, is its sheer scale and diversification. It's not just rides, not just food. It's a diversified super app with a truly global presence. Over 70 countries, 15,000 plus cities.
Compare that to Lyft, say.
Right. Contrast that with Lyft, primarily North American, rideshare focused, or DoorDash, dominant in delivery, but mostly delivery. Uber's US rideshare market share, for instance, is somewhere around 76%. Lyft is maybe 20-30%. That dominant position plus the breadth of services is a massive advantage.
That scale must create incredibly powerful network effects too, right? Can you unpack that a bit?
Absolutely. Uber's global scale and diverse offerings create a profoundly powerful network effect. Think of it like this. The more riders use the app for any service, ride, food, groceries, the more attractive it becomes for drivers and couriers to sign up because there's more demand, more diverse earning opportunities.
And the flip side.
More drivers and couriers mean shorter wait times, better availability, more reliable service for riders, which then attracts even more riders. It's a self-reinforcing, virtuous cycle. Makes it incredibly difficult for new competitors to break in and reach critical mass once a platform like Uber gets dominant scale.
More users, better service, more users.
Got it.
And profitability, we talked about that, but it's a major differentiator against competitors too.
It is indeed. Uber achieving GAAP profitability in 2023 is a significant competitive advantage in this capital-intensive industry. Many direct competitors, like Lyft, aren't there yet. Even DoorDash, while adjusted profitable, hasn't hit full GAAP profitability consistently across its operations.
So it suggests a more sustainable business model for Uber.
It reflects, I think, superior operational discipline, leveraging scale for efficiency, and the maturity of those diversified revenue streams. It indicates a potentially more sustainable model compared to many peers right now.
Their tech and data advantage must play a huge role, too, in optimizing everything.
Immensely so. Uber has vast amounts of data from billions of transactions across multiple services, multiple geographies. That enables highly sophisticated algorithms for optimizing pricing, driver efficiency, user experience. Their AI optimization is key for margins, dynamically adjusting prices, predicting where drivers should be, personalizing the app. Makes operations incredibly efficient.
And that data powers the ad business too.
Exactly. That proprietary data powers their targeted advertising business. A high-margin stream that smaller, less diversified competitors just can't replicate because they don't have the same breadth and depth of user behavior data.
So cross-selling and monetization are key differentiators. Multiple ways to extract value.
Precisely. Uber won with its 16 million plus members globally and that rapidly growing advertising segment, over $1.5 billion run rate. These are powerful, high-margin revenue streams. They weren't just add-ons, they fundamentally drive loyalty, frequency, make the platform stickier. These cross-selling capabilities and monetization strategies are key differentiators against rivals who lack that integrated multi-service platform and the data to power it.
What about their AV strategy compared to competitors? Do they have an edge there?
Uber's AV strategy is notably different, arguably more pragmatic than some. While Lyft might lean into specific robotaxi pilots with partners like May Mobility Mobileye.
Aiming for direct deployment.
Right. Uber pursues this broader platform-agnostic partnership portfolio, working with multiple leading AV developers, Waymo, Nuro, Baidu, Motional. This lets Uber add autonomous vehicle supply to its platform without being tied to one single vendor.
Mitigates risk.
Mitigates development risk, allows them to test different AV tech, potentially accelerates deployment across various use cases and geographies, all without the massive capital outlay and R&D burden of building their own. It's a smart leverage play.
And the battle for drivers, that's constant, isn't it? Where the rubber meets the road, literally.
It's an ongoing dynamic challenge for all these platforms. In delivery, for instance, Uber Eats might offer competitive incentives like higher hourly pay or surge pricing during peaks, which attracts couriers.
But DoorDash might have higher volume.
Exactly. DoorDash often reports higher weekly or monthly gross pay for drivers in many U.S. markets just due to higher order volume and market density. It highlights this constant, nuanced battle for both driver and consumer loyalty, driven by payment, flexibility, consistency of work, all those factors.
And their international presence really sets them apart from the North America-focused players, doesn't it?
Absolutely. Uber's greater global exposure, its proven ability to navigate incredibly diverse regulatory environments. That gives it a resilience that more regional players lack. While Bolt is strong in Europe, Africa, often with cheaper fares, and Didi dominates China, Uber's broad footprint lets it diversify risks and revenue across many economies and regulatory climates. A setback in one region doesn't cripple the whole operation.
So looking ahead, where are the future battlegrounds? Where will this fierce competition intensify even more?
We can expect intensified competition in several key areas. First, advertising, platforms trying to extract more value from user data. Second, autonomous vehicles, a huge battleground, not just ride-hailing companies, but tech giants like Waymo, Cruise, automakers like Tesla, all vying for share in the future of mobility.
What else?
Third, grocery and retail delivery. Continued growth, fierce competition as platforms expand beyond just restaurants. And finally, further international expansion into emerging markets where digital services are still ramping up. The fight for dominance is far from over. In many ways, it's just maturing.
What an incredible journey it has been. I mean, from two frustrated guys in snowy Paris struggling to get a cab, to a company that has fundamentally reshaped global mobility, logistics. It's truly incredible to reflect on the sheer scale of that transformation.
It really is. Uber's story is a profound testament to, entrepreneurial vision, relentless execution, and remarkable adaptability. It's an evolution from that cash-burning disruptor with the growth-at-all-costs mentality to this scaled, profitable, disciplined platform under Dara Khosrowshahi's leadership. It's more than just a business success story. It's really a case study in corporate reinvention.
And as we've discussed, its strengths today are formidable. Powerful dual mobility and delivery engines generating consistent, growing revenue.
Those profound network effects, more users attract more drivers, and vice versa. A virtuous, defensible cycle.
Its brand is globally recognized, and it's become a leader in high-margin platform monetization ads, Uber One subscriptions. Those are truly powerful competitive advantages.
Moreover, its aggressive, yet I'd say pragmatic pursuit of future tech, especially that partnership-driven approach to AVs, positions it uniquely for long-term margin expansion. Potential leadership in the autonomous future.
And the shift towards sustainability, too.
Right. Aligning with global environmental trends, regulatory expectations, building a more resilient, responsible business over the long haul.
But as with any massive company navigating this dynamic world, risks definitely remain on the horizon. It's not like it's a smooth, guaranteed ride from here.
No, they certainly do. Regulatory uncertainty, especially around gig worker classification in different places, that continues to be a key watch item, could impact their cost structure significantly.
Competition isn't going away.
Intense competition, particularly in delivery and the nascent AV space, will keep pressure on. Driver supply and costs, always a delicate balancing act for service quality and profitability. And sensitivity to broader macroeconomic shifts impacting consumer demand for discretionary services. These are the persistent headwinds they have to keep navigating expertly.
So what does this all mean for that long-term vision, that audacious idea of the operating system for everyday life? Is it achievable?
Well, Dara Khosrowshahi's vision, it's not just a catchy phrase, is it? It feels like a tangible, evolving blueprint. A multimodal, sustainable future where Uber aims to be an indispensable part of daily life for billions.
They've certainly shown an extraordinary capacity for transformation, for resilience.
Absolutely. Moving from that disruptive force, often facing public backlash, to a mature, profitable platform that's now just a fundamental part of the global economy. Its journey, marked by triumphs and tribulations, really showcases this relentless pursuit of solving fundamental human needs. Getting from A to B and getting what you need delivered right to your door.
It's incredible. From that cold, frustrating night in Paris, unable to hail a cab, to a nearly $190 billion giant shaping daily commutes, deliveries, the future of logistics across the globe. Uber's journey is clearly far from over. The question for you now is, as the world keeps moving, keeps evolving, how much more will Uber define that movement? And maybe what new opportunities might it unlock in your own everyday life?